Imagine waking up one morning in 2026, checking your bank account, and realizing the money you thought was safe has quietly lost a huge chunk of its value. No dramatic crash, no headline, just years of small, invisible mistakes finally catching up with you. That's not a scare tactic. That's the reality for millions of Americans right now. And by the end of this video, you're going to know exactly which 7 mistakes are draining people's savings in 2026, and more importantly, how to make sure you're not one of them. Welcome back to Smart Wallet USA, the channel where we break down money, savings, and financial survival in plain, no-nonsense English. If you're new here, consider hitting that subscribe button, because every week we cover the real stuff banks and financial advisors don't tell you for free. Today's topic is serious. 2026 has brought a strange mix of stubborn inflation, high interest rates, shifting job markets, and new digital banking risks. The people who protect their money this year are the ones who understand exactly what not to do. So let's get into it, starting with the mistake that's silently costing Americans the most money right now. Mistake number 1 is keeping too much cash sitting in a regular checking or savings account, earning almost nothing. This sounds harmless, even responsible. You worked hard for that money, so you keep it safe in the bank. But here's the problem. Most big banks are still paying savings rates under 0.5%, while inflation continues eating away at your purchasing power every single month. That means the dollar sitting in your account today will buy noticeably less a year from now. Money that isn't growing is actually shrinking in real terms. The fix isn't complicated. High-yield savings accounts, money market funds, and short-term treasury options are paying significantly more right now, often 5 times or more what traditional banks offer, with the same safety and liquidity. If your emergency fund or spare cash has been parked in a low-interest account for years out of habit, 2026 is the year to move it. This single change alone can add hundreds, sometimes thousands of dollars back into your pocket annually without taking on any extra risk. Mistake number 2 is relying only on a single source of income. For decades, the idea of one stable job, one paycheck, and staying loyal to one employer felt like the safe path. But 2026's job market has shown just how fragile that plan can be. Layoffs are happening across industries that once felt untouchable: tech, finance, even healthcare administration. Automation and AI tools are replacing tasks faster than many expected. If your entire financial life depends on one paycheck from one employer, you are one bad quarter away from serious trouble. Smart money management today means building at least one additional income stream, whether that's freelance work, a side business, rental income, dividend investing, or even a simple digital side hustle. It doesn't need to replace your main income immediately. Even an extra $300 or $500 a month creates breathing room, reduces panic during uncertain times, and gives you leverage instead of desperation if your main job ever becomes unstable. Mistake number 3 is ignoring your credit score until you actually need it. So many Americans only think about their credit score right before applying for a car loan or a mortgage, and by then, it's often too late to fix major issues quickly. In 2026, interest rates remain elevated compared to the ultra-low rates of the past decade, which means your credit score has a bigger impact than ever on how much you actually pay over time. A difference of even 50 or 60 points can mean paying tens of thousands of dollars more in interest over the life of a home loan. The fix here is simple, but requires consistency. Check your credit report regularly through free official channels. Dispute any errors immediately, keep credit utilization low, and avoid opening unnecessary new credit lines right before a big purchase. Treat your credit score like a financial vital sign you check regularly, not an emergency you deal with once a crisis hits. Mistake number 4 is not having a real emergency fund, or worse, thinking a credit card counts as one. This mistake has quietly ruined more financial plans than almost anything else. When an unexpected expense hits, a medical bill, a car repair, a sudden job loss, people without cash reserves reach for credit cards, and that debt often spirals with high interest rates that are brutal in 2026's rate environment. A real emergency fund means 3 to 6 months of essential expenses sitting in a separate, easily accessible account, untouched for anything except genuine emergencies. I know that number sounds intimidating if you're starting from zero, but it doesn't need to happen overnight. Start with a goal of even $500 or $1,000 first. That small buffer alone prevents most minor emergencies from turning into high-interest debt. Build from there consistently, even if it's just $50 a paycheck. The peace of mind this creates is honestly priceless, and it protects every other financial goal you're working toward. Mistake number 5 is falling behind on retirement contributions because there's time later. This is one of the most dangerous mistakes precisely because it doesn't feel dangerous in the moment. Life gets expensive, priorities shift, and retirement feels like a problem for future you. But compound growth rewards early consistency more than almost any other financial behavior. Every year you delay contributing to a 401k, an IRA, or any retirement account, you're not just missing out on that year's contribution. You're missing out on decades of compounding growth on that money. In 2026, with many employers still offering matching contributions, failing to contribute enough to get your full employer match is essentially walking away from free money every single paycheck. If your budget is tight, even increasing your contribution by just 1% can make a meaningful difference over a working lifetime. The goal isn't to max out everything overnight. The goal is to start now, stay consistent, and let time do the heavy lifting. Mistake number 6 is falling for financial scams and misleading guaranteed return investments, which have exploded in 2026 thanks to AI-generated content and increasingly convincing social media schemes. Scammers now use deepfake videos, fake celebrity endorsements, and highly polished websites promising guaranteed high returns with little to no risk. Real investing always involves some level of risk, and anyone promising guaranteed profits, especially through cryptocurrency schemes, unregulated trading platforms, or insider investment groups, is almost always lying. Americans have lost billions collectively to these scams in the past couple of years alone, and the sophistication keeps increasing. Protect yourself by verifying any investment opportunity through official regulatory resources, never sending money based on pressure or urgency, and being especially cautious of anyone you've only interacted with online asking you to invest quickly. If something sounds too good to be true in 2026, it almost certainly is, and the technology behind these scams has never been more convincing. Mistake number 7, and this one surprises a lot of people, is not reviewing and adjusting your budget as prices and circumstances change. So many Americans set a budget once, years ago, and never revisit it. But grocery prices, insurance premiums, utility costs, and everyday expenses have shifted significantly, and a budget that made sense a few years back might be dangerously outdated now. This mistake often shows up as a slow, confusing feeling of, where does all my money go? Without ever pinpointing the actual answer. The fix is to review your budget at least quarterly. Look at your actual spending versus what you assume you're spending. Cut subscriptions you forgot you had. Renegotiate insurance and phone plans annually, since loyalty rarely pays in these industries anymore. Small adjustments made regularly prevent the slow leak that turns into a major financial gap by the end of the year. So those are the 7 money mistakes Americans need to avoid in 2026. Leaving cash in low-interest accounts, relying on a single income source, ignoring your credit score, skipping a real emergency fund, delaying retirement contributions, falling for convincing scams, and never updating your budget. None of these fixes require you to be a financial expert or have a huge income. They require awareness and consistency, which honestly matters more than almost any single smart investment decision you could make. The people who come out ahead financially aren't always the ones who earn the most. They're the ones who avoid these quiet, repeated mistakes that drain money slowly over time. If this video helped you see a blind spot in your own finances, do us a favor and hit that like button and subscribe to Smart Wallet USA so you don't miss the next video, because we're covering practical, real-world money strategies every single week. Drop a comment and let us know which of these 7 mistakes hit closest to home for you, or if there's a specific money topic you want us to break down next. Your money deserves protection in 2026, and now you have the roadmap to make that happen. Thanks for watching, take care of your wallet, and we'll see you in the next one.